Thank you for joining the Founders First Capital Partners webinar, Elevating Your Company's Valuation with Growth Capital, being hosted by Founders First Investment Manager Oscar Franco. Before I get into the introduction of Oscar, I want to just provide a few little housekeeping items. The chat box is open for use. Please feel free to utilize that for any questions or comments. As well, you can use the Q&A box for any pressing questions. If it makes sense to do so, we'll answer it throughout the presentation. If not, we will tackle it at the end where we have saved some time for Q&A. And with that, I will go into the introduction to Oscar Franco, the investment manager here at Founders First Capital Partners. Oscar's been with the company for about 2 years now, and he's really well suited to present on this topic as he's worked not only for Founders First on revenue-based financing and term loans and the alternative financing that we offer here, but he also has a really extensive venture background. And I'll let Oscar speak a little bit more to his bio.
Yeah, absolutely. Appreciate it, Tracy. Once again, Oscar Franco, investment manager here at Founders First. And first and foremost, again, on behalf of everyone at Founders First, thank you for joining us today. So a little bit about myself. Again, as Tracy mentioned, now responsible for essentially all the deal flow that comes into Founders First. So reviewing all the opportunities and assessing them for potential term loans, RBF, or hybrid products that we have here at Founders First. In the past, I worked directly with essentially with entrepreneurs for the past, we'll say, 10 plus years of my life through multiple aspects, from accelerator programs to helping them connect with some other VCs, not only here in the US, but also abroad. I worked in Colombia for a while. I worked in Mexico City for a while. So I connected with not only VCs from the US, but also from Europe, Latin America. So I'll definitely, I was a part of a lot of pitching, a lot of one-on-one introductions, deal reviews. So my sense of this presentation is to provide you some insights of some of the things that I've seen in my past, and hopefully this is helpful in any way or multiple ways possible. If you have any questions at the end, feel free to let me know. I'll try my best to give you what you need. So with that, let's move on to the agenda. Okay, so this is sort of the breakdown of the discussion today. I'll be the only presenter or the speaker for you guys today. So let's do a quick recap of who is Founders First, just an overview of growth capital options out there for entrepreneurs, elevating your company's valuation. What does this mean? Why does it matter? Attracting venture capital and angel investors, a case study from Founders First, one of our portfolio companies, and just open it up for Q&A sessions at the end. I'll try my best to leave enough time to answer as much questions as I can. Now, let's get started. So who is Founders First Capital Partners? Our mission at Founders First, I always like to describe it, is to level the playing field for companies led by underrepresented founders. And how do we do it? We do it through multiple ways. So I would say one, from our nonprofit side, Founders First CDC, we do have the accelerator program. So we have multiple ones depending on the revenue stage of the company. So again, those are programs tailored for that include financial literacy, growth strategies, marketing strategies to continue to use to scale your business to the next level. We also provide grants throughout the year. This is essentially free money that also, in addition to free scholarships, to join our accelerator programs. We also do our funding side, which is term loans, RBF, or a hybrid product. And I would say just lastly, what we're doing right now, right? So webinars, content for entrepreneurs. That's essentially the main activities that we do here at Founders First. Why do we do it? Again, we believe that these groups have been dramatically underrepresented in the ranks of business leadership in the industry. So we really take that into our heart, and we want to make sure that we are changing that. And just briefly, who do we serve? Primarily companies led by people of color, military veterans, LGBTQIA+, the companies doing business in a low to moderate income area primarily. B2B component to the business, a great case study would be a service-based business, a SaaS company, just to give you a few examples. And on the left side, just some of the results of the companies that we work with, right? 63% are women-owned businesses, 78% people of color, 72% companies led by women of color, 8% military and veterans, and 45% of our companies combined are doing business in the low to moderate income area. And just as an additional recap on some of our metrics, and again, this is combining what we do on the accelerator side and what we do on the funding side. We have touched in multiple ways around 1,400 companies, whether it's through our programs, grants, combined, or our funding as well. And these are just some of the results that we wanted to share with you. 73% have increased revenues, 60% have increased profit, 56% have added recurring revenue or recurring revenue models into their business, which, by the way, I think this, for me personally, I think those are some of my favorite modules through the programs. What this brings is just thinking outside of the box of how can you create recurring revenue streams into your business model, which immediately translated to more cash inflow into the company, right? And again, just lastly, 1,000+ jobs created and around 87 million secured in external funding as well. So not only through us, but also making those introductions to other potential lenders or investors so that the companies can secure that capital and continue to grow their business. Now, let's do a quick overview of growth capital, specifically revenue-based financing and term loans. So again, more specifically, Founders First Capital Partners, we are a non-bank impact lender, and we provide revenue-based financing, which I'm going to just share a little bit more later on. Term loans, hybrid product, which is sort of a combination of both, with also wraparound advisory support services for diverse-led businesses in the U.S. Some of the characteristics or main characteristics of the companies that we work with are sort of listed below, right? So let me just do a quick rundown of those. Company has to be in business for at least 2 years, business revenue of $1 million+ or higher, meet one of the following criteria as we shared before: women-owned led business, person of color, veteran-owned business, LGBTQIA+, companies doing business in the low to moderate income area, and also companies that have committed to inclusive hiring practices, profitable, preferably break even or path to profitability. So path to profitability, primarily in the next 12 to 18 months. We're going to look at your profitability behind the business and look at that the most recent trends behind the business. So trying to understand the economics behind the business and see where essentially that profitability is going to start to trickle in, right? So we definitely take a look into that. Growing revenues or positive trends. So top line revenue, bottom line revenue, indicating growth or positive trends. Recurring contracts, predictable revenue models are best fit. Again, going back to my example, a SaaS company will be an ideal candidate for what we do. Service-based business with long-term recurring contracts, B2B or B2G, for instance, those will be a good candidate as well. Again, as any lender, investor, there are some industries that work best for us, and there are some industries that just don't fit our bucket, right? And again, if you are talking to multiple investors or potential lenders, you're going to see that this is very, very, very common in this industry. So companies that work best, I don't want to repeat myself a lot, so I'll promise I'll be brief. Again, service-based businesses, SaaS, companies with long-term recurring contracts, recurring revenue models, a few additional examples that could be a fit on a more traditional way. Marketing agencies, advertising agencies, business consulting firms could definitely be a fit. Now, some of the excluded industries that we don't fund are cannabis and marijuana industry, weapons, gambling, liquor, and nonprofits. If you are in any of those industries and you might need some introductions or point you in the right direction, more than happy to. We do have some partners that work in those industries. Okay, now revenue-based financing. A quick summary on how to think about revenue-based financing is think about it as a term loan, but instead of having a fixed payment on a monthly basis, we take a royalty fee out of the net cash receipts of the company, right? So meaning any sort of revenue that is coming in from your clients on a monthly basis, we'll take a royalty fee out of that, and that's how you pay your loan back. So for those companies that have some seasonality behind the business. If you have some stronger quarters and some slower quarters, your payment is going to be flexible through that sense. So we're in it in a way in the risk with you guys, right? On the stronger one, you're going to pay a little bit more on your loan. On the slower one, you're going to pay a little bit less. So, and again, just some additional benefits to it. Very limited financial covenants. Again, as I said, the payment specifically for RBF is going to be dependent on the company's performance. No loss of control. So we don't require as an equity investor, we don't require a board seat. We don't have the ability to replace management, take any equity behind the business. So I think it's pretty self-explanatory. There is no pledge of a specific asset, so we don't go after your house. There's no need to pledge anything like that. So that's a sort of big difference from traditional, let's put it this way, banking. Aligned interest, right? So our returns is going to be depend again on your performance. So we are very, very much aligned in that sense, which is always very important on a lender relationship. I'm sorry. Advice, again, as I've shared before, we don't only provide the loans, but we also have wraparound services as well that we can include in some of the deals that we work with. So you will still have that experience of working with a VC, but without giving away any equity, right? Happy to share more information about this. I think for sure this is one of the things that really sets Founders First apart from others out there. And just lastly, if you have an exit strategy behind the business, and if there's a potential opportunity for selling the business, right? As much ownership that you can retain, obviously the much bigger and much better the return is going to be for you at the end, right? And we're going to touch on that later on in the presentation as well.
Hey, Oscar, this is a great time to just bring up a question that was put in
Yeah.
the Q&A box about kind of explaining a little bit more the differences between Founders First and a traditional bank. I know you touched on it just really briefly. If you want to just maybe say a couple more little differences here that were not highlighted.
Yeah, for sure. I mean, not only from traditional banking, but in general, right? From any sort of alternative lender, traditional banking, or equity play, everyone is sort of mitigating risk in multiple ways, right? So depending on how they are mitigating the risk, that's essentially the terms that you are going to be able to get, right? So to answer your question, Tracy, so those 24-hour deposit funds, 48 hours, famously called as MCAs, they're able to provide you with money right away. But the way that they are essentially mitigating the risk is by doing those 50, 55%, 60% interest rates on the deals that are working with you, right? So that's the way of mitigating the risk. And now moving into the more traditional banking, instead of one of the biggest difference in terms of what we do is the pledge of assets, right? Most banks are going to require collateral to it, and we don't require any personal assets from the founder in all of our loans, right? So I think that for sure is going to be primarily one of the biggest difference. Number two will be revenue size and if you qualify for it, right? So remember, traditional banking are looking at a more, I would say, scale up, more traction type of company. 15, 20-ish, in my experience, sort of $1 million company in comparison to us, when we work with companies that are doing million plus in revenue, right? Again, there's always a time and place for different types of funding. It will don't only depend, one, what's the growth strategy behind the business? Number two, if you qualify for it, I'll say primarily those two things. And number three, how risk adverse you are as well, and how comfortable you are with some of the requirements. So again, hopefully this help you answer that question. But there's, I would say primarily those are the biggest things. I mean, credit box, and if you qualify for it, and personal assets required for it. Perfect. So jumping right in. I'm sorry. Here is an example of an RBF loan, and right after this one, I'm going to share an example of a term loan. But again, just some quick additional information on Founders First. We can do up to $1 million on a first exhibition for any of our loans. However, we can also do follow-on investments up to $2 million per company, right? So again, it's still a substantial amount of funds that we are able to provide to the companies that we work with. On an RBF, remember there is not a set interest rate. The payment is going to be variable. That's going to be depending on the royalty component to it. And we are more than happy to work on our RBF and our term loan behind any on a second position behind any SBA loan or bank loan that you currently have. We completely understand that those are very favorable terms, so we are more than happy to leave those in the balance sheet and just come on a second and third position to those. So getting into the example more specifically. So in this case, the company is around 1 million, 1 million in annual revenues. The principal is 200K. Term length is 3 years. The royalty fee is going to be anywhere between 2 to 5%. The repayment, which is the total obligation, is going to be 1.3x. So in addition of the principal plus the interest, it's around 260K. Again, divided into 3 years. And there's no early payoff if you want to pay it early. So again, just to walk you through just a quick example of how does an RBF model will look like. Now on the next slide, this is the term loan. So again, up to $2 million per company, 1 million the first tranche. In comparison to an RBF, in this one, there's gonna be a set interest rate. There's gonna be a fixed monthly payment. And again, we're more than happy to say that on a second or third position, depending on your debt schedule and on the type of loans that you have. If you have an SBA bank loan, again, more than happy. Pretty much the same scenario. The only big difference will be the payment, right? So instead of having a variable payment, this is going to be a fixed payment with a set interest rate. So in this example, it's going to be 7,222 per month. Now, getting into more specifics on why we're here, right? So elevating your company's valuation. I touched on this in some of my earlier slides, but there might be a few others that are not necessarily represented here, but this is the funding landscape, let's put it this way, of options that entrepreneurs can have or can get access to, right? So on the left side are your mode, quote unquote, traditional bank loans, right? Again, very square credit metrics. The company needs to be a certain volume in terms of revenue sales. They will require collateral most of the times, I would say the vast majority of the times. But again, the interest rates are going to be relatively low. Again, remember, they're able to do that because they're mitigating their risk with in other ways, such as the collateral and some other stuff. Then on the right side of that, you have your MCA loans. This is as I shared before, that get funds in 24 hours, 48 hours. Minimum review, they just take a look at your bank statement, see the amount of money that flows in, the amount of money that flows out, try to do some analysis or quick analysis to it, and just provide you with some money, right? The way that they and most of the times they're unsecured, maybe they don't require any PGs or personal guarantees. But again, the way they're mitigating their risk is their interest rates are just so high. I've seen a lot of the deals that sometimes come up with us here at Founders First, and they have a lot of capital stacking out of those MCAs, right? So when you think about it from a cash flow management perspective, having to make daily payments, weekly payments at such a high interest rates, I mean, it just really impacting their cash flow management, right? So again, there's always a time and place for different types of monies, but just to make I want to share that with you. Just make sure to be strategic. Have a growth plan behind that. Don't try to get another MCAO to pay your current MCA loan. Just to try to be strategic about those funds. Now on the right side, you have your angel investors, VCs, essentially equity investing, right? Equity investing historically, and you can see it again in most recent years as well, are a great fit for a very specific type of company, right? Primarily are high tech, sort of high growth type of companies that have a potential exit strategy, have a potential IPO, merger, so on and so forth, right? So companies that have a very high tech component to it and that are growing on a monthly basis, year over year, 2x, 3x, 5x. Those are essentially a great sort of are very attractive to the equity world. But again, sometimes a more quote unquote traditional business would not necessarily fit that bucket, right? So Founders First, revenue-based financing, our terminals and hybrid products, we'd like to position ourselves in the middle, right? So yes, the underwriting and everything that we do are essentially loans, but as again, with our wraparound services, we also provide some things that traditionally equity investors provide, and we're able to do that with our expansion services as well. So we like to position ourselves in the middle. If you already raised some rounds in the past, just to give you an idea, we like to see ourselves sort of a post seed round, maybe early series A. We're there primarily. It's where we think we might be potentially a better fit for the companies. Continue on. Okay, so this is just a very clear representation of ownership, right? So on the left side, it's a company that has traditional equity in the business around, in this case, 45% ish of their shares have already been um, diluted. Um, so the ownership stake or the 100% of the shares of the company are now not only owned by the founder, but also by a third party, in this case, an investor, right? And now on the right side, if you are completely owned of your company, you have completely um, independent decisions on where do you want to take your company, right? That's another thing that is really important. So if you can continue to the next slide, I think the next slide really represent this information perfectly. So equity dilution. And again, this does not necessarily mean that equity funding is a bad thing. Don't get me wrong. No, there's I think equity investing is also a great resource for companies to work with. But some of the things that you also need to consider is the reduction in the ownership stake, the decreasing control and decision-making power behind, funding difficulties for future rounds. And in this, I want to touch on some additional bullet points in here. Reduce founder incentives. I've seen this, by the way, in the past, where there was a VC that was interested in investing some money in a particular company, but when they were doing the due diligence, they had a review on the cap table on the business, that they noticed that the equity owned by the founders was very minimum, right? So if you don't have incentivized founders, and you're also an external investor trying to figure it out if this is not an opportunity for you, that could generate a lot of friction for sure, because you want to make sure that you have founders that are invested in the company, that still have some sort of control, veto rights, that can essentially, because they are the ones that started the business, right? You're Even though you're investing in the company, you're also investing in the team. So making sure that there's no friction behind that are some of the things that investors really take into consideration. Negotiating power, right? So if the founder's equity in the business is less than 51%, then you're not only negotiating with the entrepreneurs, you're also negotiating with all the rest investors. So from a negotiation perspective, it's going to take way more time. Remember, equity fundraising takes a lot of time, especially at later stages. And then alignment of interest, like I've shared before, from an investor perception, um, if you don't have an incentivized founding team, it can really jeopardize the way that you view that company, right? So we need to make sure that founders are incentivized, have enough ownership structure where they can make decisions on the business, because you're also betting not only on the horse, you're also investing on the jockey. And especially at a very early stage, I mean, you're primarily investing in the background of the team. So continuing on.
Actually, before we move to the
Yeah.
next slide, a question came through, and I think it's a really great point to bring up. With equity financing, do you have to give up any stake in your company, or is there equity financing without giving up stake?
So there's different instruments, which I mean, I'm more than happy to share. I think the best way, we might even do a webinar on this, by the way, but there's some investing instruments that investors usually use to invest in companies, right? So just to give you an idea, safe and convertible notes. So those are essentially debt that can potentially convert into equity at some point. So to answer your question, there might be a lot of safe convertible notes introduced at a very early, specifically at a very early stage, because they don't want to create a lot of more work getting a company valuation when the company's at a very early stage. So it doesn't make sense. So they usually do these instruments. So they're essentially dead. They have the opportunity to convert into equity. But to answer your question at later stages, equity investing is equity investing. So there you can get into the details of there's different stocks and there's preferred stocks. But again, I'm just overcomplicated things. But if you're interested about that, let us know. More than happy to do a webinar specifically related to that.
Great. Thanks, Oscar.
Yeah,
I'm going
absolutely.
to continue on now.
Perfect. Okay, I just want to make sure which slide we're in. Okay, perfect. These are just a few examples of not only deals that I've seen here at Founders First, but also deals that I've seen in the past. So, example number one, a company looking to preserve ownership in the business. So this is a tech startup that primarily in the beginning of their history or their growth journey, they the only access to capital that they have was equity fundraising, which makes sense, right? But there comes a time where the company hits some certain milestones. Maybe the profitability in the business is starting to show. Founders are starting to notice that they don't have to continue the equity round and that they actually can get access or are eligible for other types of funding, in this case, debt. Um, and that is an opportunity for them to continue to invest in their company without giving away any additional equity in the business. I've seen that multiple times. So again, remember, it doesn't mean that if you're starting your business from an equity perspective, you'll need to continue that route forever. There's going to be a time and place where the company's mature enough that you're going to get access to some other multiple types of fundraising. So that's an example that I want to share with you. Number two is optimizing capital structure. And again, from an investor perspective, I know for a fact that investors really like seeing this. So this is essentially a mix of having equity, but also some debt behind the business. So this what indicates an investor is the maturity behind the business, 100%. So that means that someone that has a very well thought process, understands their growth strategy, understand what are some of the growth initiatives that they're working on, and try to assign different types of funding for different types of need behind the business. And again, from an investor perspective, that really translate into a lot of confidence into the founding team. Option number three, again, leveraging on opportunities. And this is specifically, again, a little bit tied up with how the time we expend on equity fundraising versus debt, right? So just to give you an idea, and this is not a commercial, but if on the founder first side, we can make up a decision from getting to know an opportunity to funding, I would say in 3 or 4 weeks. Again, depending on how responsive the customer is. On an equity side, especially at the later stages, those will take months for sure. So if there's a necessity behind the business, you're aspiring about a growth opportunity, and you qualify for other types of funding, I mean, consider that as one of those options for you, right? So that's essentially option number three. And again, just the fourth piece, which is sort of included on some of the previous one, the investor perception, right, as well. Having that mixture between both speaks a lot about maturity behind the business. Now, attracting venture capital and angel investors. So in here, there's a few things that I wanted to share. Hopefully I don't spend a lot of time. I know I want to make sure I leave some time for Q&A for you guys, but so these are the first four things that I wanted to talk with you. So develop a business plan. Business plan, pitch deck, growth plan, 5-year growth plan, whatever you want to call it. But make sure you have something written down that you don't have not only have the initiatives and the information, you have the financial model, you have the modeling, you have the projections. Having all of that in hand will definitely help you not only fundraising, but also having a very strategic growth plan behind your business. You know, the first thing that you need to evaluate is stage 1 to stage 2 to stage 3 to continue to scale your business. In this part right here, and sort of tied with the market and the market opportunity, I want, from the investor side, I want to understand whatever problem you're solving, how big it is. I mean, essentially, how many people, how many companies are facing the problem. And again, it doesn't necessarily have to be the bigger the problem, the better it is. I mean, yes, from some industries and for some times, but there's also maybe a potential niche market where there's a huge necessity and maybe there's no solution for that program, for that problem. That can also translate into a great opportunity or a great investing opportunity, right? So again, make sure to understand how big is the problem, the growth strategy behind the business, and in addition to that, just the last component to the business plan, before I get into the other topics, it's I always like to describe it as what's your secret sauce? I mean, is it what's the uniqueness behind the product and your service that is setting you up apart from your competitors? There's some competitive advantages to have essentially a more clear advantage. So a great example would be if you're a very high tech company and if you have the only solution like that in the market, you have a patent to it. I mean, that's like the biggest thing you can get, right? However, if you have something related to maybe the pricing structure, and maybe you're one of the cheapest alternatives out there, yes, I mean, that can be a competitive advantage for a while. But the truth is, I mean, your competitors, you can have a competitor that can match your prices and then your competitive advantage is gone, right? So try to figure it out what sets you apart as a business from what is out there in the industry. Um, Build a strong team. And again, going back to equity investing, specifically at a very early stage, I've always liked to share some examples in the past. Unfortunately, I cannot share company names, but I remember a company, the background of the team, I mean, amazing. Not only from their experience in the industry, track record, um, they've done in the past. They've been founders in other companies as well with successful exit strategies. There was they did a pitch presentation for an investor that I personally know, and then they end up securing like $1.5 million out of a PowerPoint presentation, right? At a very early stage, I mean, there's not much to the business, right? Because it's essentially an idea or maybe some very minimum traction to it. So they're essentially investing on the team behind the company, right? So if you want to start a business or co-found it with someone, make sure that it's very aligned with not only with your vision with the company, but also provide some additional layer to your team. And more specifically, maybe their expertise is complementary to yours in many ways, so that when you combine yourself as a team, you're going to stand out from some of the other startups or companies out there. Showcase traction and milestones. Again, especially when you're starting to become you're starting to transition from a startup company to a scale-up company, um, making sure that you're getting that data behind whatever you're measuring in. It can be revenue growth. It can be I don't know, acquisition strategy. It could be KPIs, it can be NPS, it can be churn, it could be usability behind the business. Whatever metric you think is really important to showcase that your company's having some great traction, make sure you're keeping track on it. And if there's multiple ways to showcase that for investors, so start thinking about those things. I remember even a company once created, I don't remember which one was it or what specifically the KPI was, but they created a KPI just because there was nothing out there in the market that can specifically talk to what they were measuring in, right? And I remember talking to investors, and investors love that idea, right? So make sure you can be creative behind that. Moving on, networking. Go to events, conferences, pitch events, accelerator programs, incubator programs. Leverage your network. Try to connect with people on LinkedIn. Use Crunchbase. Use PitchBook. I mean, you're gonna need to talk, and especially from an equity perspective, to a lot of investors to get to the ones that make sense for you. My piece of advice would be one, do your due diligence behind the VCs that you want to work with. I mean, so most of the companies have their portfolio public on their websites, so make sure to log into their websites. Try to look for some companies, reach out directly to the founders and ask for their experience working with them. I mean, that could be a very easy idea. But in addition to that, based on the fund, based on their managing directors, based on the people that work there, their investment thesis, their mission, try to do a ranking of your ideal investor, right? So do separate them into different tiers, tier A, tier B, tier C. My advice, I've got this advice out of a very successful entrepreneur that I met once, was if you're starting to do like pitching to them, my advice would be start with your tier C. The reason why is you will get a lot of feedback, not only on your pitch, but also the type of questions that they're asking for that you can then use for your tier B. Then subsequently you can use for your tier A. So once you get to your tier A, you're going to be much more prepared for those conversations, right? So that's a quick tip that I want to share with you. Again, practice your pitch, elevator pitch, the famous 30 seconds, your one-liner, your 5 minute, your 10 minute. Make sure you have up-to-date materials that you want to share. I mean, I can tell you a lot of examples of companies that either share a deck with me and then subsequently send a follow-up email like, hey, some of the metrics are not up to date, but just to give you an idea, sure. I mean, I can get an idea based on the business model, but I will definitely will love to see more updated metrics, right? So make sure that every now and then you're updating your deck. My recommendation would be probably every quarter. If you're pitching a lot, probably once a month. Just update those numbers. Will be my advice. Again, market opportunity. I think I touched on that in the past, and just due diligence. Um, I'm sorry, projections. Projection is the one that I was missing. So projections, essentially the ones that I talked to in the beginning of the business plan. It's a big component to the business plan. Use of funds. Why are you asking for that money? What will be the specific use of the funds? If you have it to the dollar, I mean that speaks a lot of your preparedness for those meetings, right? So make sure you have realistic expectations. You have a clear use of the funds, and if asked for projections, I mean you have them handy, right? So yeah, make sure to have those things up to date as well. Now the due diligence process. Due diligence. Sometimes they're going to ask for your data room. There's a lot of technology behind that, which I don't want to get into it, but there's different technology tools that VC funds are using for this process. But what I can share specifically about the due diligence is one, be transparent. I cannot emphasize about this enough. Be transparent. If there's something in there that you know for a fact, maybe it's something that are going to be questioned, make sure you bring it up front. There's no worse feeling in the world that going into whatever due diligence process you're in, and then finding out something about the business that eventually kills the deal, right? So be transparent about everything behind the business. That's one. Number two, make sure you have again up-to-date documents. I cannot share. I can share a few examples of some companies that I work with here at Founders First, where they when we were going through the due diligence process, every time we asked for a doc or an updated version of the doc, we get that document right away, right? So on our side, we're making our job way easier by just being on top of things. But in order to do that, you need to make sure you have not only the technology, your, for example, your QuickBooks in order, and also if you're working on projections, make sure you're revisiting those every quarter so you can have up-to-date information you can share to potential investors as well. And just lastly, exit strategies. And I always like to end on this note, specifically on the equity side. You need to remember how equity investors make money, right? So there's primarily three different ways that investors can make money. One, there's an exit behind the business. So if you're selling the business. Number two, if there's a possible IPO, which I mean, there's a lot of IPOs going specifically for more specifically for high tech type of companies. So if you have very high ambitions, that could be potentially a strategy. Again, out of the most common exits, I would say that's primarily the minimum type of exit that you see. And number three would be through fundraising activities. So from time to time, depending on moving from Series A, Series B, Series C, there's going to be some cleanup in your cap table, right? So some investors are going to come in, some investors are going to come out. There's going to be some return in there. That's essentially how investors make money. So that's why there are investors for different growth stages, right? So usually your angel investors or already early stage investors usually never see those at a very later stage type of negotiations because again, there's a time and place for different type of investors. And just quickly, we wanted to share this example with you. The company is Quality in quality interactions. So Ashley, as the president and one of the co-founders behind Quality Interactions, Quality Interactions provides cultural competency e-learning for healthcare experts. They started with the healthcare industry, but now have evolved into some other industries such as um, state and city governments, and also educational institutions as well. So Quality Interactions reached out to founders first around 2018 for an RBF loan, and we started with 160K loan. From there, we did a follow-on investments in 2022 for around 250K. Remember, we like to see ourselves a long-time strategic capital providers for the companies that we work with, right? Not only that, I always like to showcase this example, but they also were a part of our accelerator programs, right? So they graduated boot camp, which is our program for companies doing 250 to up to 1 million in revenue, and they went to into our advanced program, which is fastbat for companies doing 1 million plus in revenue, right? So they're also took advantage of our accelerator programs, which I always encourage the companies that work with. By the way, I always get asked this question: do I need to graduate from the programs in order to qualify? And the answer is no. We can do both simultaneously. From there, the company grew around 300% out of the top line revenue. They included new revenue streams. They're double the size of the team. They were listed under the Inc. 5000 class of 2002. And right after funding, after 2022, after having multiple follow-on conversations with Ashley, there was an opportunity, and they were in a much better position to pursue venture-backed investing, right? So with the help of our founder, CEO, Kim Folsom, we leverage her network and the network behind the firm to connect them with some potential investors, right? And I'm happy to share that we were able to help them in achieving that success, right? So Johnson & Johnson Impact Ventures was one of the investors among others that were part of that round. But again, talking about specifically where we are in here, right? It's leveraging that for improvements within the company, continue to scale and use it for growth capital, put your company in a much better position, more attractive to equity-backed investors. So once you go out and eventually go into pursuing that route, you're going to be in a much better position to negotiate. One, company valuation is going to be higher. Number two, number three, you're going to get access to different tiers of investors that maybe at an earlier stage you would not necessarily have, but you needed the funding, right? So that was a great alternative in this case. So I just wanted to end on that note, and open up for questioning.
Okay, thank you so much, Oscar.
Yeah.
And that was such a great case study to end on, because it really does sort of exemplify why growth capital can help your company elevate their valuation and set them up, like you said, for investors that wouldn't have talked to them before. So thank you so much for that. We did have a couple of questions that came in that we didn't address throughout the webinar. One of them being, maybe if you could touch on some disadvantages or reasons why debt financing wouldn't be the right choice, and then also equity financing, why it wouldn't be the choice for your company.
Yeah, I mean, there's the obvious ones, right? So for instance, if you're not the most obvious one, if you're a very early stage company, right? Maybe you're in the ideation phase, maybe have a few months of traction, getting access to some debt is going to be difficult for sure. So equity fundraising, and especially some angel investors probably, and if there's a tech component to it primarily, it's going to be a best fit for you. Again, the counterpart to it is if you are a little bit more mature business, maybe on the traditional side, and you don't qualify, or you're not necessarily a good fit for an equity investor, or from an equity investor's eyes, let's put it this way. But remember, they are expecting 10x returns on average on the investing that they do, right? So on a more traditional side, maybe the growth pattern that the company have are not necessarily going to get into those numbers, but you're still a growing business. Don't get me wrong. Debt, again, might be a better option. So that's primarily from like criteria selections that you may or may not qualify for those. Now, from a strategy component to it, it will depend behind on the strategy of the business. So I've talked to multiple founders that retaining equity in the business, control over their operations, independency, or being independent, it's a main focus. So 100%, if that's the case, then equity opportunities are going to be essentially less attractive than debt. And then on the other side, there's some other founders that maybe have some negative experience on debt or have maybe don't are not willing to put any collateral or personal guarantees behind the business and they just would rather give away equity and have people as investors within the company. I mean, I can see them pursuing that route. Again, not all funding opportunities are one fit all for all types of companies. Again, I always encourage entrepreneurs to do your own due diligence, to do a little bit of research on some of the opportunity you have that there, and try to come up with your very conscious decision of why you believe whether it's equity or debt that might be a better fit for your business. But the good thing is sometimes you're going to have options, and sometimes you're going to get access to both. So try to manage those.
Great, thanks so much. We did have a couple of other questions that came through, but it looks like we are out of time or a little bit over time. So we're going to go ahead and send to everyone that registered and attended our webinar a follow-up email with access to the slides, and we'll try and get some of those questions answered as well. Thank you again, everyone, for joining us, and we look forward to seeing you at the next one.